Hey guys, what's up? Hope you guys are having a great day today. My name is Matthew Spazzi, and welcome to the TradingView profile, or my TradingView profile. Hope you guys are enjoying your week. It's been a pretty decent week for me overall. I have actually had not a really bad week at all, to be honest. I came in, the other day. Let me show you this real quick. Sorry, I'm going to go ahead and pull it over here. Actually, so this is my trading analysis journal. This is what I use all the time for my trading. And as you can see here, the past, 6 trades ended up being very, very profitable for me, which, as you can see here, yeah, that's not always the case. A lot of times, this is all trades that I take on TradingView with regards to this currency pair portfolio that you see here. Dollar, Chilean peso, I don't actually trade. It's just there because I like to watch it every now and then. But, the very idea here is that I love to basically just trade. I love to post my trading analysis. And this is all just me practicing my analysis, practicing, reading the charts and things of that nature. And yeah, so that whole Excel sheet that you saw there, that was representative of me trading all of these currency pairs, all the way down to the dollar yen here. So it's a lot of currency pairs, and not all of them are back tested. The only ones that are back tested are the dollar CAD. Not the dollar CAD, I'm sorry. It was the Aussie CAD, the Aussie USD, and the CAD Swiss. So far, I have a positive expectancy on all 3 of those, and it's been going pretty good. That said, though, what I trade here, for those of you guys who are brand new to the TradingView profile, is I trade a trend continuation strategy, which basically states that once the market makes a new high, like it does here, I have to take my fib retracement measurement tool and measure from this swing low to this swing high right here. And then if the market retraces after it makes a new higher high, higher close, and breaks this price level, this structure level here, and once it retraces into a 618 fib retracement, I go ahead, and in this case, I would get long because it's bullish. We broke out to the upside. That would make a bullish trade for me. So I would get long. Now I did. Unfortunately, in this case, I ended up, I ended up getting stopped out. See, in order to place a stop loss, I placed a 10 pip stop loss from the lows, which I'm going to show you right here. See, we've got 88.81, so we're going to put our stop loss at 88.71. So let's find that. Perfect, right there. That's where our stop loss would have gone. And as you can see here, the market came down and totally, just barely gave it a love tap. But I got stopped out nonetheless. And now the market is rallying. So here's the interesting thing, though. Not only did the market stop me out, but it also closed. It made a new lower low, lower close. It closed below this structure level. That, to me, is a bearish indicator that the market intends to continue lower, or at least that there is a possibility of it doing so. So I went ahead and reversed my analysis, and I decided to short the market instead of going long like I was doing before, which is what you see here. I took my fib retracement tool, I measured from this structure high to this structure low, so swing high to swing low, and I got my fib 618 fib retracement right here. And that's how I got this strategy. I placed 10 pips away from the highest high here, the most recent highest high, so we're 10 pips above here, and I placed my target at the lowest close, or at least the lowest body of the candlestick. The body of the candlestick, the lowest part of that. So if I was taking a trade here, let's see. Let's assume that we were going to measure it from here to here. Let's assume I got involved. Okay. So where would my target have been? Just to give you guys an example of this, aside from the one I've already drawn in, the target would be here, because this is the highest close that it made. Now, sometimes you actually will have a, green and red candlesticks. The reason I say the highest point or the lowest point, if it's bearish, the highest or lowest point of the body of the candlestick is where I place my target, is because sometimes, you don't always have the opportunity to place your target right on the lowest close. So if this is the lowest close option here, what if the lowest close was up here? What if the red candlestick was all the way up here? It gapped down and then it rallied. So the lowest close would have been all the way up here instead of down here. Okay, so that's why I don't say the lowest close, because that has happened to me before. So that's why I say I just place it at the lowest point on the actual main body of the candle, and I don't place it on the candle wick. And this oftentimes helps me to secure profits quickly. A lot of times what will happen is the market will come in here and it will almost get close to the end of the wicks and then not quite, and then end up leaving. Now, if I placed my target here, I might miss out on some trades, but on the vast majority of trades, I probably would make money. So if I was going to do that, I'd have to retest everything and go from there. I would rather just take my targets here, take the profits here. I mean, honestly, from here, this is 88.70. Oh my gosh, I think it's 88.73, right? So if I was to carry this down a little lower, you're looking at 88.66. So it's really not that big of a difference when it comes to the actual profits and things of that nature. That said, you know, when you're trading, you need to be willing to shift your analysis and shift the direction of your analysis in the middle of a trade. Or maybe not in the middle of a trade. But you need to be willing to shift your analysis, right? So if the market decides that it's going to go in the other direction, flip your analysis and go the other direction. Don't be so tied to the idea that we're bullish here, right? We've been bullish since April 30th. So don't be so dogmatic and tied to the fact that we're bullish and be unwilling to shift your trades. We have bullish trades that are inside of bearish trends. I mean, we have bullish trends that come inside of bearish trends. We have bearish trends that come inside of bullish trends. The market is always, you can have trends within trends within trends. That does happen. So right here, if you were to look at this chart right here, I know I just zoomed out, but what would you say we were in? Well, you know, from this point, April 13th to about, I'd say May 10th, we were in consolidation. We weren't really trending at all. But from February 18th to March 18th, we were definitely in a bullish trend. And then from March 18th to, you know, April 14th, we were bearish. And now we consolidated. Now we're bullish again. Now, overall, what are we? Overall, since, let's go ahead and look at the daily here. Just consolidating. Honestly, we're just in consolidation ever since October of 2016. We've just kind of been, you know, going back and forth, and we're just in a whipsaw. We're just consolidating now. Now, if you were to look back to 2009, we were clearly bearish all the way until August 15th, 2015. And then we were bullish from 2015 up until, I'd say, probably October 2016, October 4th, 2016, and then we started consolidating sideways. So that's the overall idea, is we're consolidating. So we really, the market overall doesn't really have much of a direction, in my opinion, at least just from that quick analysis there. I could also zoom out to the weekly to get an even better look at this. But that being said, not only have I flipped my analysis, but there is something else that's also interesting here. Many of you probably have caught your eye on this, but if you didn't, I'm going to draw it in for you. Right there. Now, what is this? This is, well, it looks like a W, right? But what this really is a head and shoulders pattern, or at least the potential formation of a head and shoulders pattern. If it was truly a head and shoulders pattern, the market would come down here. Right? Let's do this real quick. The market would come down here and it would break the neckline. All right, that's exactly what would happen if this was a head and shoulder. If this was an actual head and shoulders pattern, the market would come down here, break the neckline, which is right here, and end up reversing. Now, the head and shoulders pattern has been called by many people. It has been called the most consistent trend reversal pattern. Now, I can't really speak to that. I don't honestly know, because I'm going to be completely honest with you, I've never back tested, I've never even traded head and shoulder patterns before. It very well could be. Now, I've back tested double tops and double bottoms and things of that nature, and from what I can tell you, it's okay. You know, they're not really that consistent, to be completely fair with you, and they're kind of rare to find. At least it's rarer than the trend continuation strategy that I have. But it's, yeah, I don't really know, I don't know particularly, you know, what exactly the consistency of a head and shoulders pattern is. Sorry, I'm getting distracted by something. I don't really know the consistency of the head and shoulders pattern. I don't. That said, though, some people really, really like them, and I wanted to highlight this. Now, if this is a pretty good sign, because I'm thinking that we're going to be shorting, and if this is a head and shoulders pattern, if it actually forms, right now, it hasn't formed yet, it's kind of in the process. If it does end up forming, then this is going to be good. I'm going to end up making money. So, in this particular trading situation that we have here, I have the confluence of a number of things. I have the confluence of that there is a potential head and shoulders pattern forming. I have confluence that we broke structure and made new structure low. And then I also have confluence here that we were also overbought on the relative strength index right here. Okay, if you kind of look down here, look over in the far left corner there for the numbers, we were at 89.47. So on the relative strength index, we have a pretty good confluence here. That is usually a bearish sign. If it's overbought, that's a bearish sign. Let's see if we have a confluence right here, which is actually where the market has today. 82. So we are slightly overbought right here as it stands today. This is, again, a bearish sign. So we've had two bearish signs in a very short period of time. So we have relative strength index, we have RSI confluence, we've got confluence of a potential pattern setting up, or at least we have a potential confluence if it decides to. We have confluence of the market breaking below, closing below. And then we also have confluence of the fib retracement, the 618 fib retracement that I showed you here. So this is all looking like there's a very, very good chance the market is going to go lower and not higher. Honestly, guys, what's really going to happen? Is that really going to happen? I'll be completely fair with you. I don't know. I have no idea. I don't really know if that's going to happen or not. I hope it does, because then I would hypothetically make money, right? All of these trades are hypothetical, right? All of these trades are just me practicing my chart analysis. That's the purpose of all of this, okay? I'm still in the back testing phases of my trading journey and all that kind of stuff, and all of this is just me showing you guys how I analyze the markets. Even though I might not be trading money live, although I have traded money live in the past, and I've made money in the past, but I'm not trading live today. I've learned that in the past, it's best to backtest a strategy and forward test a strategy before you trade it. So that's what I'm doing. So that said, this is just me performing chart analysis, coming every day, or at least every week, and, you know, performing the analysis and showing you guys the process. I mean, I've been studying trading for, 5 years now. I think possibly 6. I've been studying trading for a very, very, very long time. And I can tell you that it requires a lot of practice in order to get good at it. So, anyways, guys, I hope you enjoyed this video. This is my very first TradingView video, so I hope you liked it. You know, there's a lot of really cool stuff that we're doing here. And, yeah, if you liked it, hit the thumbs up button. If you liked it a lot, make sure to also comment. And then, you know, I always appreciate it when you guys comment. It always means a lot to me when you comment. It shows me that you're engaging with me, and it just shows me that you love what I'm doing. Also, if you really, really like this analysis and what I'm doing here, and you're getting value out of this content, you want more, then hey, consider following me, and so you can have access to all my trading ideas and all that kind of stuff. So guys, if you will do that for me, I'll see you guys in the next video. As always, know the risks, plan accordingly, and have a great day.